Welcome back, dividend growth investors and value investors. Today I will share with you my stock analysis about BASF. No wonder it has been requested so much by you because there's so much to do about this company. As an example, not too long ago, Russia invaded Ukraine and this has a lot of impact on BASF. At least if we start following the headlines, because as an example, BASF is an investor, indirect investor in the Nord Stream 2 Baltic Sea gas pipeline project, which has been cancelled by Germany and of course under pressure of the European Union. But it doesn't stop there, because if we look at the current sanctions and the threat of Europe to also ban entirely the gas imports from Russia, then the poison cup looks even deeper to swallow for BASF, because they are already warning for a catastrophic economic collapse if Russian gas exports are halted. The CEO went even that far to mention that as well they could close down one of the biggest chemical plants in Europe in Ludwigshafen. This is a lot to do about BASF, and in today's video I want to talk to you about their commitment to the dividend and the dividend history, the impact of cycles on BASF, the impact of the Russian war with Ukraine on BASF, the impact of inflation, what their current growth prospects are. I will also compare it a little bit to two other stocks in the industry, and ultimately I will give you my opinion about the valuation about BASF. But before we get started, if you like this kind of content and a little bit of a deep dive into European or American dividend growth stocks, then please subscribe to this channel and like this video. Okay guys, let's get started. So guys, as a dividend growth investor who is already investing since 2014 in a well-diversified dividend growth portfolio, for me, a commitment from the CEO and the board of directors to the dividend is of course of utmost importance. The worst thing that can happen to me is that during, for instance, a financial crisis, an economic downturn, a stock market crash, that I'm losing my passive income, of which I like to retire from. What we can see here in BASF's history, that they started already way before 2000 paying a dividend, but you need to know that most of the dividend histories for European companies are only really, useful since 2000, when they switched from, for instance, the Deutsche Mark to the euro. Since then, they have been growing their dividend from 65 cents per share to 3.40. This is approximately a five-fold, which is really not bad in 20 years. However, what we can see here is that during the great financial crisis in 2008, the company thought that they had to cut their dividend, and they cut the dividend at the time at about 10%. This is not a lot, and in a well-diversified portfolio, I would have probably been looking at an income loss of 1%, and probably that would have been covered by other companies growing their dividend. So while it is a dividend cut, it was not a severe one, and what you can also see is that by 2010 they already made up for this dividend cut back then. So what is more reliable for me to look at is what they did during the pandemic last year. So during the pandemic they kept their dividend flat. So from that point of view, I would say BASF is really not doing that bad from a dividend growth history point of view. Although, of course, I would have liked to see them being more committed to the dividend in 2009. But that was then. We're talking already now about the time zone, which is like 10 years later, a decade later. So what we can see here is that with their latest hike from €3.30 to €3.40, which is about a 2% hike, let's say, they recommitted again their ambitious dividend policy, as they call it, of increasing per share dividend each year. So just from a dividend growth point of view, as what we can see in the evidence, plus what they are mentioning in their dividend policy, I believe that this company is quite committed to their dividend growth. So having said that, now that we know that this company is committed to the dividend, I think there are a few things important to at least consider. So if we look at it, the current yield of the stock is 6.5%. This is really a lot, and this is one of the highest paying dividends in Europe at this moment in time. I currently own 70 shares at an average price of €51.17. That's not so much from what the current share price is trading at, and I have built this position, I believe, 2 or 3 years ago. What I also have done is most recently I bought 100 additional shares as part of a dividend capture strategy. My friend, Engineer My Freedom, does this a lot, and I really want to try it as well one time. So the idea here is that I bought 100 shares, capture the dividend, and then sell them back again. So if this would all work out well, I should be able to make a potential profit in, let's say, 2 months time span of €695, because what I've done is I purchased those 100 shares, I sold a call option at €54 for €2.05, and if the price will be after the dividend, let's say at 20 May when the options expire, I would also make a capital gain of €150, and that would make this entire profit there. This would be just in 2 months 7.2%. I believe we're looking here at the annual return if you really want to extrapolate it to 60 or 70%. Not going to do that because it makes no sense, because this is only possible once a year for a stock like BASF. Other two important dates are quarterly one earnings are there in 1.5 weeks from now. So everything that I say in this video might be neglected based on the news that is coming out. But on the other end, we don't know what the shares will be doing between that time frame and now, so we want to make an investment decision today. Last but not least, the company goes ex-dividend the 2nd of May, so if you still want to grab some shares to make benefit of the dividend, then you can do that before the 2nd of May. Last but not least, I would say, this company has also a buyback program announced, I believe a month ago or something like that, in which they intend to buy back shares in the value of 3 billion until the end of next year. 3 billion right now would make approximately 1.8% annually based on the current market cap of 51 billion. I think this is important to know if you consider to invest in BASF right now, or if you want to wait, for instance, another 1.5 weeks until the earnings results are out and final. But you know, companies like BASF are not for the light-weighted stomach out there, because there's a lot of cyclicality around this stock, and this is what I want to show you a little bit now, because some of these companies like BASF, you don't want to buy them at the top of their cycle. As an example, if we go back to, for instance, the autumn of 2008, just before the great financial recession, you can see that the stock was trading around 46 euro at the time, and before that at an all-time high of 50 euro and 70 cents. After that, it dropped all the way to the bottom of around 20 euro. So we're talking here about a 60% stock decline. This is massive. Luckily, it recovered quickly again all the way in 2011 in a span time of 2 years to 68, so it almost tripled in that time. So what I want to show with this is that this company is really volatile if we look at it from a share price point of view. And we can see that the stock has been growing up and down all the way to a peak of 86 euro. In 2016 or the end of 2015, there was also an oil crisis, which slaughtered the stock with another 30-40% share price depreciation. It recovered, but since the peak in 2018 of 95 euro, the company has not been back anymore. So at the moment, today it's trading at 51 euro, almost at the same price at which it was trading at the peak at 2008. So you could argue that if you bought it here within 13 years, you have not seen anything from a capital gains point of view. Of course, from a dividend point of view, you've tripled your dividends almost, but you know, this would have been the only value you would have gotten out of BASF. And this is something you need to take really into consideration if you want to build up a long-term position in BASF, because this is not, in my opinion, a stock in which you need to invest from a share price point of view, unless you want to buy it at the bottom and sell it at the peak. I can't do that. I'm really poor at market timing, so I rather buy to hold. And by the way, that the share prices fluctuated so much here, is really in lockstep with their earnings, because if I look back at the earnings report or the annual report from 2011, you can see it here. Just go to the earnings per share. It was making 4 euro per share in 2007, 3 euro in 2008, and then all the way to 1.5 euro in 2009. But you know, it recovered quickly again to 5 euro and 6.74 euro thereafter. Just for your information, in 2021, it made 6 euro per share in earnings. So also a decade later, we're not even making what the company was making in 2011. So to sum it up, for me, BASF is really a cyclical company that you really need to buy when the company is under stress. So the question is, of course, is the company under stress right now? Let's have a look at the impact, therefore, of the Russian war on Ukraine. What you need to know that one of the first things that I mentioned before is that BASF is an investor in the Nord Stream 2 project. Of course, this project has been heavily debated and there has been a lot of opposition towards it, specifically from many of the Eastern European countries, because they never trusted Russia and they were always against Nord Stream 2. What is actually also really controversial about this project, that if you go back to, for instance, 2017, the reason why 5 European energy companies committed to provide long-term financing is because of a country like Poland, in which I live, rejected a joint venture creation between these 5 companies together with Gazprom. That's why it was a financing deal. These 5 companies invested approximately 50% in this 9.5 billion envisioned cost of a project. So if you're not familiar with this deal, of this financing deal, you will see that BASF is not mentioned here. But that's because BASF owns a large parts of Wintershall. And that's visible here. And if you look into their annual report. So if you go into their annual report, you can see it here from 2021. BASF holds 67% of the ordinary shares. But if you take also the preference shares into consideration, BASF owns 73% in Wintershall Dea. This is important to know because now we can follow the news of Wintershall. And also guys, you only need to read few pages of the annual report to figure this all out. So it's really not that difficult. Really the quote of and the mantra of follow the money really applies here. And this makes us also way more informed investors. Because like I always say, you need to know what you own. And with BASF, you have direct exposure to this deal of the Nord Stream 2 project, which is really of course controversial. And as an example, if we then go to the recent news from Wintershall Dea, you can see here what they have decided. No additional projects in Russia, payment transactions already stopped, critical infrastructure will continue to be operated, so they will keep their assets that they currently have in place, and, they will write off its financing of Nord Stream 2, totaling around 1 billion euros. There you go, the 1 billion they invested, poof, gone into thin air. And it has already been confirmed by BASF, because if we go to the recent preliminary figures for the first quarter of 2022, so this is not yet their quarterly one earnings report, which will come on the 29th of April, you can see already that, their sales to be expected is higher than 2021, which is good. But special year back then, lockdowns, different time. But look at it here. Net income reached 1.2 billion, considerably below the figure of the prior year quarter because of an impairment recognized by Wintershall Dea, particularly for the loans, of which BASF included its net income from shareholdings on a proportional basis with around 1.1 billion. So this is really how you see the money flowing from Nord Stream 2 project to Wintershall into the earnings report of BASF. So yes, there is a direct exposure here, and that's why we shall see lower net income coming up in 1.5 weeks from now. I believe this is already priced into the company. So what has my curiosity really is what their cash flow will be. Because this is a non-cash impact. The cash has already been paid over the last few years and already recognized in the report. So from a free cash flow point of view, I don't expect any impact from this deal. However, going forward, of course, there's less free cash flow coming in because the Nord Stream 2 project is not going to deliver gas that BASF needs. So guys, but this is from the Nord Stream 2 project. But hey, there's another way of figuring out what the potential impact of the Russia war on Ukraine is. And just, write an email to the investor relations, and they have responded to me. So they say some blah blah blah. They've been operating for more than 145 years over there. But here, Russia accounted for 1% of the BASF Group's total sales. So in my opinion, we shouldn't worry about this at all. And we just saw that their sales were increasing again. What is actually more important here is that BASF needs most of the gas as its Verbund site in Ludwigshafen. Natural gas is one of the top 5 feedstocks. So to be able for them to produce chemicals, they need gas and a lot of gas. What they also say is they use it to generate electricity and steam, of course, in their power plants. But now it comes. Russian natural gas accounts for 30 to 40% of gas supplies in the EU and 50% in Germany. They purchase natural gas from Western European suppliers, not directly from Russia. But it's part of the energy mix. So at least I would like to show with this the misconception that BASF is buying directly gas from Russia. Still, it will be having a massive impact if Europe decides to cut off the gas import from Russia, of course. And yeah, maybe the CEO is right that they can close Ludwigshafen. However, I would say that the mix is already changing. And there's also warmer season coming up. Liquid natural gas is being purchased. There are deals being made with America, other sides of the world. A company like Shell transports a lot of liquid natural gas. So I believe that also the CEO from BASF is scaring just people because they have actually a cost benefit getting this mix from Europe. Because of course, if we need to import liquid natural gas from Saudi Arabia, from America, it will be at an expensive price. And this will hurt the company, of course, because the margins will be lower. I don't believe in a catastrophic event of an economic impact. I believe this is just scare politics. But okay, that's my humble opinion here. I believe it's in the interest of the CEO to make people scared. But if we just use common sense, I believe BASF is just one of the companies out there. I think as Europe, continental Europe, we will do actually better in the long run. So I'm, from a political point of view, totally supporting this. But hey, this is not about politics. This is about investing. So yes, you need to take this into consideration if you want to make an investment case for BASF. But let's go back to the facts then. Yeah, because if we look at the gas price here, the gas price really spiked if we look at the Dutch gas, natural gas future, because that's really what we're talking about. It was €225 at the time, at the peak of the fear around the war on the 7th of March. It already dropped all the way to €95. And this is not so far off from the trend that it was already taking, because the times from last year when it was trading around €22, those are gone. You can see it already. Inflation kicked in, but we're now back to normal inflation. That's what we're seeing here. Not so much the Russian impact anymore from my point of view. But this can, of course, easily change really quickly. There's also summer coming up. So, we're at the end of winter season in Europe. Who knows what will happen again, of course, going forward. But on average, in the upcoming quarter, we should see average gas prices as what BASF was already experiencing back in quarter 4, 2021. So having said that, if we look at it from an impact of the Russian war on Ukraine on BASF, I think there's definitely an impact there that we need to discount for when looking at this company, but it's not so scary, I believe, as what the company is putting in the news and what you as an investor are also witnessing in the news. The facts to me speak a little bit different here. But hey, now we know this, I think there's another important topic here on many people's minds, as I could see on Twitter when I ask what to talk about when looking into BASF, and that is inflation. And inflation is real, but it's so nice when you just read again fucking annual report, because BASF is all explaining it already to us. If you go to their forecast by segment for 2022, they're already telling you what their forecasts are. They're already expecting chemicals to go down, materials to slightly go up, and so forth. And if you read it, it's all over the place. I highlight it here. We expect sales to decline of chemicals considerably following very high prices in 2021 due to supply shortages in the market, while higher raw material prices will put pressure on margins. It's all over the report, yeah? Supply chain plus impact on prices by inflation. So what they're expecting then is an earnings before interest and taxes of approximately 6.6 billion to 7.2 billion. Of course, we know now that there will be already 1 billion less or 1.1 billion less because of the impact of the Nord Stream 2 deal. That was not known yet at the time of writing of this report. So in my opinion, inflation is all over the place and the company thinks that it cannot easily pass on all the inflation into the prices to their customers. However, there's a little bit of good news there, because where they can do it, they are doing it, because just recently they did a press release on the 22nd of March in which they announced that they will increase prices for its Care Chemicals portfolio globally. This is a small, relatively, let's say, small portfolio, but still chemicals as such is one of their biggest parts of the portfolio. So yes, where they can do it, they are increasing the prices, but in my opinion, inflation is hurting them a lot and there's no easy way out for a company like BASF at this moment in time. So also here, once we calculate the fair value of the company based on future cash flows, we need to take this into consideration. Okay, so the next topic I would like to talk about really briefly are the growth prospects of BASF, because we know now where it's hurting based on the Russian war, based on the inflation. But what is actually the bull case for BASF? And honestly, it's not so easy, because it is a really boring, slow-growing business, but really important to the world. But if you then think about opportunities, where can this company literally still grow? I mean, for such a large company with such a presence all around the globe, I believe it's already operating in a saturated market. Of course, it has really high entry barriers for any other company to enter this market. So from that point of view, BASF will not go away anytime soon. This is the example of a slow compounding company. It took them more than 100 years to come here. This will also take like 50 years to break up this company. But still, I believe that if they focus more on highly specialized materials, for instance for the automotive industry, specifically when you also think about EV and all the innovation that is going on, they will be able to enter a higher margin business, simply said, because companies or customers, let's say, are willing to pay a little bit more for such cars at this moment in time. If we then also look at what they are intending to do with climate neutrality and products to support it, I believe this is a growth area, or at least a tailwind for the industry, because governments are heavily investing currently in climate change, and BASF has some of the products to support them there. Last but not least, I believe if they would do some targeted acquisitions and also disposals to create a higher margin business, BASF should be able to grow their earnings in the upcoming years. So having said that, I believe there are some growth opportunities, but expect this to be slow growth opportunities. And we just spoke a little bit about the risks already, or actually quite extensively, so I'm not going to repeat all of them again. An economic crisis on top of this should really impact the company and probably hurt the company. But you know, I can tell you already, the company has a good balance sheet. It's prepared for that, and I will show you that in a while. But before we go there, because we're still in the opportunity space, there was also a person on Twitter when I asked about BASF who told me, please, have a look at their ESG requirements and ratings, because he thinks that their ESG ratings would decline based on what's happening now with Ukraine and based on everything what we're seeing out there at the moment. Honestly, for me, ESG is one of the biggest scams in the world out there. I've looked several times in there, and if I look at the companies that are typically in there, come on, this is just a scam. For me, there's really so much pollution in all these companies going on. And what you really see there is the intention from those companies to do better. So from my point of view, I'm not an ESG investor. However, as an investor, I need to take this into consideration, because in companies like the Netherlands and Germany, many investors are just looking at the ESG criteria to define and to make a decision whether they actually want to invest in an index. And indexes and ETFs are one of the biggest money inflows at the moment coming into the stock market, specifically also from pension funds. So it does matter. So it does matter if BASF gets a decline in a rating in ESG, and we should expect at that moment in time probably the price to drop 5 to 10% or even more, because companies and pension funds will have to throw it out of their funds. Again, I think it's one of the biggest scams based on the analysis that I've done so far already. But well, I need to take this into consideration. So thank you also for this Twitter user that was bringing this up. I think it's an important point to consider also when looking at the growth prospects. Let's see, I really am not knowledgeable enough to predict this from ESG point of view, but yeah, it does matter. Okay, so having said that, I believe that we have looked now into many things that we can think of if we look at the actuality and the news of BASF and what's really in people's mind. Before I go to the valuation and whether their dividend is safe, I want to show you something else as well. Look, there are more companies out there than BASF alone. There are also industrial competitors like Dow and LyondellBasell Industries NV. Both are listed on the New York Stock Exchange. And currently, what you can see here is from a valuation point of view, from price to earnings point of view, you could argue that Dow Inc. and LyondellBasell are actually currently cheaper from a multiple point of view. They also pay a nice yield, 4.2% for Dow and LyondellBasell 4.16%. What's important to know here that Dow Inc. has a dividend growth track record over the last 5 years of 0%. Effectively, they've been paying 70 cents every quarter for the last 5 years. LyondellBasell has a growth track record actually of 1 year because, like BASF last year, it had frozen its dividend, but it has a higher dividend growth rate at this moment in time. From a payout ratio point of view, it's paying out just 27% in dividends based on their earnings, compared to BASF, which is 56% right now. So if you would look at it from a growth point of view, you're probably better off based on these simple metrics looking into LyondellBasell. It's currently 4% yield, really low payout ratio. So it's better positioned if we would hit a severe economic crisis right now, because from that point of view, you could argue already that their dividend is a little bit safer. You would still get some dividend growth with it, which probably outpaces the dividend growth that BASF can give you. On the other hand, it will take them 5, 6, 7 years to get there. And in the meantime, you get the fat BASF dividends that you can reinvest and let the compounding and let the money work for you. So I just wanted to show you this a little bit because I got also quite some questions here to compare it to the industry. Based on some high level metrics, let's say screening criteria, I believe that it's either BASF, high yield, low growth, or Lyondell, decent growth and still decent dividend growth. So it's up to you. I will now continue with the fair value assessment of BASF. So guys, one of the first things I always ask myself is the question, is the dividend safe? Based on the analysis and based on my dashboard, actually the dividend is questionable. What you can see here is that the safety score ranking says that when it's between 40 and 60, it gets a questionable safety ranking. Why is that? Well, simple. It didn't score all the points for whether the company was showing growth, because we see low free cash flow growth. Balance sheet wise, no problem, looks really well. Payout ratio point of view, it also got only some points because of the free cash flow again. And then from a dividend commitment point of view, it didn't get all the points because the last recession has a flat dividend and we want to see growing dividends. But what hurts the company the most in this dividend safety prospects is that I gave it a neutral company growth prospect. Because as I showed you earlier, I find it hard to find some really strong tailwinds for a company like BASF. But to be honest, if it would have just scored a few points more, it would have been the safe category. So it's really, I believe, in the high end of the questionable, and I leave it up to you whether you agree to this or not. Okay, so let's start looking then into the key trends of the company. And I always like these overviews a lot, because what this shows you, for instance, is that in the last 5 years, the share price went nowhere. The bottom for me at the moment is around 40 euros. When you look at how the company did at the start of the pandemic, it's now trading at 51 euro. I'm not a technical analyst, so if you are, please share with me what your forecast is from a technical point of view. I can really not say that here. From an EPS point of view, you can see here what the impact is of a pandemic. Yeah, it straight away had a negative earnings per share and a free cash flow impact that was actually quite significant. And this also, when we look at the fair value of the company, we really need to take into consideration. The dividends are always nicely covered by the free cash flow, except for 2020, as we just saw, but it's really not an issue there. Share buybacks as well, they are coming up now, but so far they were not really done a lot by the company. If we then look at it from a balance sheet point of view, you can see that the cash is already nicely here, and the equity is far bigger than the long-term debt. And that's why we saw already that there is a debt to equity of about 33%, which is a really good and strong balance sheet. So the company is really conservative when it comes to that. And they understand that because of the cyclical nature of their business. Because if they are having a lack of free cash flow, they will probably need to leverage up a little bit. But with that, they can continue to pay at least a flat dividend going forward. Okay, so if we then look at the rest of the metrics here, you can see dividend growth 13 years, currently is dividend yield of 6.5%. We mentioned already a slow dividend growth. That's why it's not meeting the Chowder rule criteria, because then it should have 12% here. I believe almost everything is on green because of the valuation, as you can see here. But what I also want you to know is that their return on invested capital is like 10.12% over the last year, and their weighted average cost of capital is 9%. So there's not a lot of value creation for the shareholder. And again, limited growth prospects, limited shareholder value creation really means you want to get a high yield in return for this slow growing business. Okay, what is also important, I believe, to know is that their gross margin has been declining actually since 2016, when it was topping 32%. And that's also one of the reasons why we see the share price going down. From a free cash flow point of view, by the way, if you look at it, in 2015 it had 3.6 billion and last year 3.7 billion. It went a bit up and down, but it really went nowhere over the years, right? So also here, there was a little bit of growth, but not a lot. So this brings me then to the fair value calculation of this company. What I've done here, I've taken the 5-year average free cash flow. Why? Because it is not showing a stable growing free cash flow. So if we take the 5-year average of 3.7 billion, let's say, and based on that, a growth rate of about 5% over the next 5 years and 3% thereafter, and a discount rate of 10% with a terminal multiple of 14, I believe that the company should be worth 63 euro approximately. Please remember that the multiple currently is 8. This means that a lot of the share price appreciation will come from multiple expansion. If you don't believe it and you reduce the multiple to 10, you're talking about a totally different fair value calculation, probably in the low 40s here. And actually we see that here, because if we take a bearish scenario with a growth rate of 3% and 1%, and then a terminal multiple of 11, we're talking about 48 euros here. So all in all, if you look at this and you take my assumptions into consideration, I believe that the fair value of the company is currently 62 euro. However, there's really one more thing that I want to show you here, so please don't tune out yet. Because let's imagine that next year we will face really a hard economic crisis, right? Okay, so let's validate what the impact would be. Let's give it a free cash flow of 3.7 billion, as we just said, 5% growth rate overall, 3% thereafter, a 10% discount rate, and a terminal multiple of, let's say, 14, as we saw in the earlier. But what I want to do now here is, let's say that we will have 2 bad years, and let's say that we will make just 1 billion in free cash flow each year. So I want to deduct 6 billion in free cash flow over the next 10 years, let's say, because that's what I'm expecting. What we're then talking about is a fair value estimate of 53 euro. This is really nearby the current share price. I believe we will see in the next 10 years a strong economic recession, and I really believe that's realistic, that we will lose 6 billion in shareholder free cash flow that we own. Yeah, you can even make it worse. If you believe that the company will never get back to a terminal multiple of 14, but rather trade at a terminal multiple of 9, like what we have been trading now at, we're talking about a fair value of 42 euros. I believe this is actually quite realistic if the company continues to having some headwinds. So I've given you here a few scenarios where my fair value, based on the assumption that 3.7 billion will grow by 5% first and then 3% thereafter, of 63 euro. But if really shit hits the fan and on a terminal multiple of 9, I believe that the company will be realistically valued at 42 euro. Having said that, I own already 70 shares because I don't count those 100 shares from the dividend capture point of view. What my strategy is to sell those 100 shares again based on the option income that I'm also generating, expecting that it at a certain moment will get exercised. However, my target position for this company is ideally 100 shares. So what I will do if the company would drop in the next recession to about 40 euros, let's say low 40 euros, I will top up my position with an additional 30 shares so that it makes 100 shares and completes my entire position. So this brings me also to the conclusion. I believe that the 6.5% yield is worth it. I believe that the dividend is safe, even though it's on the questionable end of it. I also believe that the company is already attractively valued if you want to initiate a position right now, but also if you want to own it for the 6.5% yield. If you're really greedy and you have time on your hand, I would suggest probably to wait a little bit because I believe we are not done yet when it comes to the share price decline. However, I can tell you, at the bottom of a recession, I rather buy shares in Nike, Microsoft, and Apple, Procter & Gamble and such than BASF. That's why it will be really limited for me to 30 shares. But that's my take on it. I find that the economic recession is best suited to buy high quality companies, and these companies like BASF you can also buy at other moments in time, like for instance this week. Having said that, this is it from my side. I hope you found this video very informational and entertaining. If not, let me know also. I always love to improve myself, so feel free to give the feedback in the comments. Otherwise, just give me a thumbs up and show your love also by subscribing to me. Guys, if you want to see more of this, check the video on the left, which is another stock analysis, or check the video on the right, which shows you a more informational video around dividend growth investing. Having said that, have a great week ahead and see you next weekend.